Given oil's recent drop in the last couple of minutes, I want to ask you, when you look out in a macro way, how does crude oil factor into all your investment decisions that you guys make at Principal?
Well, I think the thing with oil is, sorry, I think the thing with oil to remember is that it's a cyclical risk asset. So people are going to be worried that a drop in oil prices is signaling, more of a concerns about global growth going ahead. But you have to remember it's cyclical. There are concerns on the supply side because of what's been happening with the various tensions between the US and Iran, and then providing waivers to those to various countries. So there's a supply glut, which is then also feeding through to a concerns about global demand. And this is, pushing through. And then, of course, we have technical factors. So you may have seen, the very sharp move that you saw last week, and potentially is also the case today, it's difficult to say at this stage, is really about technical factors with people being stopped out of their positions, and then that unraveling pushes another downward leg in oil prices.
Okay, so it matters. So oil is part of sort of the macro mix, Seema. If you had to factor in then the one or two most important things to you guys and your team right now, macro, anything, Brexit, trade, U.S. economy, what would it be?
Okay, well, there's two main things, and I would say the first one is Fed tightening. So how much are they going to be tightening next year, and how does the market deal with this? So where is it relative to what markets are currently expecting? And the other thing is, of course, it's the trade war. So how much worse is it going to get, and how much of that fear factor is actually priced into the US? From my perspective, I think it's fully priced in for China. We've already seen a very, very sharp decline in Chinese equity markets and also the Chinese economy. But I think for the US, people are still very early stages about understanding what the potential impact could be on the US economy. So those are, for me, the two things. Now, of course, just one more thing with oil prices, where it really feeds in for us is about how it impacts high yield. Energy companies tend to be a huge part of the high yield universe. So a further downward leg in oil prices inevitably hits high yield spreads.
Yeah, you're bringing up, Seema, such an important point. And, we were talking about the oil story a few years ago extensively on CNBC when oil prices dropped. And people said, well, why are you talking about oil so much? Gas prices are down, and that's good. I said, no. Yeah, it's good for retail. It's good for consumers. But there's so much debt tied up in the oil markets that needs to be repaid. And, of course, as prices go down, your cash flow slows down often, or your free cash flow dries up, and you've got to pay that down. How much of this really oil story is actually a debt story?
A lot of it is a debt story. And the other part to remember is, a few years ago, the US was a net oil consumer, net oil importer. But of course, that's changed with shale. So now it's an oil exporter. So you see a drop in oil prices, it no longer has that very, very positive effect. It's somewhat offset by the fact that there's producers in the US who are kind of sending out their oil and will be hit by oil prices. And then on the debt side specifically, for high yield, we've already seen that blowout in spreads over the last 2 or 3 weeks. And the key thing for that has been that downward drop in oil prices. So anything further is creating further credit stress in the market, which is an area which people are already very concerned about.
That's why we have to watch the HYG high yield ETF. Hey, Seema, listen, it's a holiday week here in the States. Leave us with some optimism. Okay, futures are down pretty big right now. But how big of a chance is there that by the end of the year, about 30 days or so of trading, that we get a year-end rally in the U.S. equity market? Give us a little hope.
Look, it's entirely possible. The first thing to remember is that it is Thanksgiving week, so liquidity levels are extremely low, so you're going to see more volatility, so bigger moves than maybe you usually would. And then there is some reason to expect, we've had very, very strong buybacks in November. You have investor sentiment, which is so negative that it's almost due for a positive move. So those things are telling me that there could be some relatively positive news ahead. And of course, the retail numbers from Black Friday and Cyber Monday, as you were just talking, could certainly push the market forward. I would say, look, on a positive note for further into 2019, that we don't expect a bear market by any means. We're not expecting a global recession, a US recession. So what we think is there could be further falls in equity markets, but by no means is it a bear market ahead.